Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Okay, before we start this video, another thing just to briefly go over is that if you look in the description of the video, underneath the video, there is in part of that description of the video, you'll find a section that is for links and descriptions to other videos on different topics about the SPX Daily Key Levels indicator, which is as you see here. So if you would like to see further details on any particular topics that are covered here, some of these we may just briefly go over in this particular video today, and we'll reference this section in the video, and you can return to the video description to look up that topic and look at a more detailed video on that particular topic. Thank you. Hello, in today's video we'll be taking a look at the Friday, October 31st, 2025 trading session for the SPX CBOE index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator for trading SPX 0DTE options, and we'll be specifically using the newest version of this indicator, which just came out a few weeks ago, the V2.0 version. Okay, so some of you may be already familiar with how this indicator works from seeing our other SPX videos on this YouTube channel, but for those who are seeing this for the first time, who are not familiar with the indicator, I will run through how this indicator works before we get into the details of the trades for this session. Okay, so this indicator works on the TradingView platform, and it works on two different SPX symbols. One of the symbols that it works on, if you go to TradingView and you type in SPX, and then you look under SPX for the SPX symbol in the CBOE exchange. So that is the main official CBOE SPX index that everyone follows, and this is a symbol that you would use the indicator on if you were trading SPX index options, which is the main strategy with this indicator. It also works on a second SPX symbol, which is the SPX 500 8 cap, which is a Forex CFD. Here is this symbol, SPX 500. So on TradingView, excuse me, you would go to the SPX 500 symbol and type that in, and then you would look for the 8 cap exchange, and this is a Forex CFD. You would use the indicator on this symbol if you instead trade SPX through a Forex broker on a Forex CFD. So this would not be trading SPX index options. This would instead be trading it through a Forex CFD. Now, another reason that you might use it on the SPX 500 8 cap symbol is if you were involved in a trading challenge, such as with the brokers that offer trading challenges in which you can hit a certain profit goal within a certain amount of time without hitting a certain loss limit, and then you can qualify for a funded account. The brokers such as FTMO, Apex, the 5%ers, there's probably 50 or 60 more of them that offer those, and so typically if you're with that, it's usually with a Forex broker through them, and you would be trading SPX through Forex, and then you could use this indicator for that purpose. The other reason that you would have the SPX 500 chart open if you're even trading CBOE SPX index options like we are going to show you in the main strategy is that while it is on that symbol, you can get the levels for the CBOE SPX index 30 minutes before the CBOE SPX index opens at 9:30 a.m. Eastern New York time. So at 9 a.m., which we have marked off here on this chart, this is the time that you would see this display on your screen while it's on the SPX 500 symbol. So you'll see a table for the SPX 500 8-cap levels here, which are the same levels here for the SPX 500 8-cap. And then you will also have this second additional table here, which is for the CBOE SPX Daily Key Levels, and this would be for the 9:30 a.m. open of the CBOE SPX index. The reason why you have to have it on this symbol in order to get the levels 30 minutes early for the CBOE SPX symbol is because the way TradingView PineScript works, that if a specific symbol that you have your indicator on is not open, which in the case of CBOE SPX, it is not open until 9:30, unlike the SPX 500 Forex CFD. So while it's on the Forex CFD, since that is open, then the indicator can show you the CBOE SPX levels via this second chart 30 minutes early, which gives you a jump on the CBOE SPX market open 30 minutes early at 9 a.m. So this gives you time to do some planning and also take some time to perhaps look at a couple different strategies depending on whether you're using the main strategy for this indicator for index options, which we'll be showing you today, to use with this indicator, or you're like many other traders that use this indicator, you use one of the other option strategies that are popular, such as iron condors or butterflies or spreads or other types of combination trades. Okay, so now we'll go back to the other chart. Okay, so we're back on the main CBOE SPX index symbol. So for the most part, the majority of traders use it on this symbol to trade SPX index options, as this is the main strategy. The main strategy by using this indicator is for bullish signals. You are simply buying call options on bullish signals, or you are buying put options on bearish signals. So the main strategy with this indicator that we demonstrate on our YouTube channel in all of our SPX videos is that particular strategy, which is very simple, and it simply involves buying put options on bearish signals and call options on bullish signals. Now with this indicator, the main key level that you will see on your chart while it's on CBOE SPX when the 9:30 open comes and the first tick of the 9:30 open, you will see these levels on your chart, which are the new updated levels for this particular session. So each day at 9:30 a.m. while it's on the CBOE SPX chart, at the first tick you will get the newly updated levels. These are going to be the same levels, the main levels that you'll see on the SPX 500 chart on that second additional table that you can also see 30 minutes early at 9 a.m. Now you'll see many different levels on the screen here, and the main level for the session is going to be, and the most important level out of all the key levels, is going to be the SPX Bull Bear KPL, which stands for key price level. We'll also be referring to this level as the BBKPL throughout the video. And this particular level is the all-important Bull Bear key pivot for this particular session. So after analyzing recent price action, market volatility, and current market dynamics, as well as pre-market and overnight action, this is the all-important Bull Bear key price level that the indicator is coming up with after analyzing this through its many algorithms. And for today's session, that number is 68.7694. Now with this indicator, in about 95% or more of the sessions that of the 250 so daily sessions for SPX that you'll see throughout an average year, and 95% or more of those sessions, the bull bear key price level is going to be the main level at which you would consider taking trades off of, either on the 9:30 a.m. opening candle of the session or in the first opening minutes of the session. So that is going to be the level that's primarily in play at the beginning of every session in 95% or more of the sessions. As we mentioned in the preview to this video before it started, there is a section in the description of this video which has links to other specific topics of this indicator. One of those topics is 9:30 a.m. candle trades that you would want to avoid. So if you'd like to see more details on that particular topic, those sorts of instances might happen 3-4 times a year to maybe as much as 10 times a year. So it's also important for you to understand when using this indicator the few times you'll see sessions where you will want to avoid the opening 9:30 a.m. candle trade if you're normally inclined to use that. Now with that in mind, when the opening moments of the session, the bull bear key price level is the main level that you will either be taking a bullish or bearish trade on if you're going to be taking a trade in the opening candle or opening minutes. The main R levels above, which those are R1 through R6, are going to be your take profit levels on bullish trades derived and generated from signals of the bullish signals from the bull bear key price level. Conversely, the main S levels below S1 through S6 are going to be your take profit levels for bearish trades taken off of this main bull bear key price level. Now with this indicator, you can also take bullish and bearish trades off of the other main levels. So all the main levels for this indicator, for this version of the indicator, is the bull bear key price level, as well as the main R1 through R6 and S1 through S6 levels. The other levels that you see, the midpoint levels and the QL levels, serve other purposes, which I'll explain in a few minutes. So as far as taking trades and entries off of the key levels with this indicator, you can also use the main R levels and main S levels to take either bullish or bearish trades depending on what price action is showing you as far as possible bullish or bearish entries. At those levels, it's just typically those types of entries on those other main R and S levels are going to become more apparent usually later on in the morning part of the session or later on in the afternoon session. Typically at the beginning of the session, decisions would be primarily based on the bull bear key price level. And we do have a video on taking trades off of the other main R and S levels. That description and link is in the video for the description of this video as we went over in the preview. And that particular video also goes over the two different types of trade entries that you can have with this particular strategy with this indicator. The standard entry for either bullish or bearish trades, as well as the more conservative trade entry for bullish and bearish trades off of any level, which that more conservative trade entry requires additional confirmations, which makes it different from the standard entry. So that also goes over the two different types of trade entries, how to recognize them, and when to use them. Alright, so you'll also see these other levels here: PMH, PML, YDH, YDC, and YDL. The PMH is the indicator's SPX pre-market high. The PML is the indicator's SPX pre-market low. The YDH is the previous sessions or the previous session or yesterday's RTH session daily high. The YDC is the previous RTH daily session or yesterday's daily close. And the YDL is the previous day's RTH session low. Now these can also play important roles throughout the for general context of the current session. They are very important key levels as well, and they can also be used as decision-making points for profit taking or making adjustments and management of your trades if they occur in what's known as regular trades with this indicator after if they are positioned in a zone that is occurring after the minimum required profit exit trigger levels for regular trades, which we'll get into later on. Many of you may already be familiar with that concept from seeing our other videos, but we will re-explain it again in this video as well. They also can serve as points of reference for continuations and also for where price may stall or reverse out. So they are important to keep track of as well as these other main levels. And they're especially important if to keep in mind if they occur in confluence with other main levels. So as you can see here with this PML that is near the S1 level, and you also have this PMH, which is near this midpoint level here, and then you have the YDC and YDL, which is occurring in confluence with this midpoint level here. Now on any given general day, price is going to have to start closing above the PMH, the pre-market high, on consecutive candles and hold above that if we're going to see any sort of substantial rally. It is going to also have to close not only above the bull bear key price level, but it's going to have to also start closing above that PMH level as well. And the same thing goes in the reverse for the PML level. If we're going to see any real substantial downside movement, it's going to not only have to start closing below the bull bear key price level, but also start closing below the pre-market low on a consecutive candles basis. Okay, you'll see these two tables here. These two tables are independently controlled, and they can be either enabled, which they are on default, or you can turn them off if you do not wish to have them on your screen, because you do have the line labels as well. These can be, especially this table, can be useful sometimes if you have price for some of these levels that is very close to each other. Sometimes these lines and labels will overlap, so this can be useful as far as discerning the exact prices at times if that is the case. If you do not wish to have them, you can turn them off in the user control panel if you do not wish to have them taking up space on your chart. All of these line labels are individually controlled as groups, so the PMH and PML is one group, the YDH, YDC, and YDL is a different group. The main levels, meaning the bull bear key price level and the main R&S levels, are one group. The QL levels are one group, and all the midpoint levels are one group. So for the line labels, you can control all those by individual group as far as the size of the line labels, making them smaller or larger, and also the offset of the labels, moving them more over to the left or to the right as a group. And like I said, you can also control the size of the line labels by group as well. As you can see, we have the main levels in the large text size, the midpoint levels in the normal text size, the PMH, PML, YDH, YDC, and YDL are all in the normal text size, and whereas the QL levels we have in the small text size. If you prefer a different look, then you can customize that in the user control panel. There are lots of other features, lots of other customization and display features, which we're not showing right now. And there is a video on all of the features of this particular indicator, as well as all of the user inputs. And that link to that particular video is also found in the description of this video if you would like to see a video on all the different inputs and all the features and all the display customizations that you can do to your preference with this indicator. Okay, so we're going to also explain these midpoint levels before we get in these QL levels. The midpoint levels are, you can turn on the midpoint levels above and below each main level. So on the default display, the only midpoint levels that are turned on by default at startup when you first get the indicator are the midpoint level above and below the bull bear KPL. And the other ones you would turn on manually in the user control panel. Typically you would turn those on in the direction of where price is heading to, or if you prefer to have them turned on by default, to have more midpoints turned on by default, then you can set up a different default display other than the one that just comes native with the indicator. The other native display levels are going to be turned on by default when you first get the indicator, are going to be the QL above the BBKPL and the QL below the BBKPL, which are tight stop losses, as we'll get into in a second. Those are also available to be turned on any off of below and above any main RRS level, and those primary use is for tight stop losses on either bullish or bearish plays. The midpoint levels, however, have many different purposes, one of which is for standard stop losses above and below a level that you're trading. So that is one of their uses. The other use is for continuing momentum gauges between levels. Oftentimes starts closing above the midpoint level, it is often headed towards the next main level above, if it happens to be bullish activity above or bearish activity below the midpoint level, usually an indication that it is at least going to test the main level, next main level below. They also can be used as waypoints for decision making on profit taking and adjustments to your trade for stop losses or scaling out. However, those come into play on regular trades only after the move has moved at least a minimum required amount in your favor. Okay, so starting off here, we have the 9:30 a.m. candle. This is the 9:30 a.m. candle for this session. We're on a 2-minute chart. If you've seen our other videos, you'll see that when we are putting the strategy on display with this indicator, that we use the 2-minute chart in all of our videos. We found that for this particular main strategy for use with this indicator is the best chart time frame to use. However, the range of chart time frames to use for this particular strategy can range from 1 minute to 5 minutes. So if you prefer a different time frame while using the strategy, then you would want to use something between 1 minute and 5 minutes. However, in all of our testing and using the indicator ourselves, we found the 2-minute to be the most consistent chart time frame to use for this particular strategy, although it does also work well on between the 1 minute and 5 minute chart time frames. In general, this indicator works on chart time frames of 1 minute up to 30 minutes. So 30 minutes would be the maximum time frame this indicator works on. If you try to use it on a time frame higher than 30 minutes, then a disclaimer will come up on the screen telling you that you need to put the indicator back between a chart time frame of 1 minute and 30 minutes. Now, if you do use this indicator for a different strategy, a different option strategy than the main one that we show to use it with, such as selling options as opposed to buying them, or using it for spreads, or iron condors, or butterflies, or other types of combination trades, then you may find that a longer chart time frame of 10, 15 minutes, 10 minutes, or 30 minutes may work better for those particular purposes. Or other traders that use it for those types of strategies, and generally speaking, when using it for those types of strategies, a longer time frame may be more favorable when using this indicator. However, as I said at the beginning of the video, the main strategy with this indicator that we show in all of our videos is simply buying puts on bearish entry signals and buying calls on bullish entry signals. Okay, so the opening candle here, we have the 9:30 opening candle. It does open above the bull bear key price level. However, it crosses below and closes below the bull bear key price level. So that, if you are inclined to take a 9:30 a.m. opening candle trade, that is going to be your bearish entry signal on this opening candle. Now, taking the 9:30 a.m. opening candle trade is optional. It's not. There's no requirement to take it as part of the strategy. You'll see that unless there's some aberration, as I talked about earlier, that may happen somewhere between 3, 4, 5, or maybe up to 10 times a year out of the 250 or so trading sessions. There are times where you would not take the 9:30 a.m. opening candle, and that has to do with how far it closes above or below the bull bear key price level. So that detail about ones to avoid is in the description, link to that video that goes over that in more detail. So there are times where even if you are inclined to take a 9:30 a.m. opening candle trade, because it does close above or below the BBKPL, there are a few instances a year that will happen where you will want to avoid that trade and not take it. And then we go over what the adjustment is as far as the session in that particular video as well, if you want to take a look at it. But on this particular day, this is a candle that does fall into that range. So if you are inclined to take the 9:30 a.m. opening candle, then you would take a bearish trade off of this candle. However, there are many people that use this indicator for this particular strategy, which prefer to wait for the session to play out, for perhaps the opening range to play out, where the opening range may be the first 5 minutes, it may be the first 15 minutes, 30 minutes, or hour. Those are typically the common opening ranges that people a lot of times like to see before they start entering into trades. If you're more of that mindset, then you're looking to take trades off of other levels and let the session play out some, so you can still use this strategy in that case as well, because there is no obligation to take the 9:30 a.m. opening candle. You can simply wait until price is trading on levels that you prefer to take bullish or bearish trades off of instead of the bull bear KPL later on in the session, meaning the main R or S levels. So there's no requirement that to take trades off of the bull bear KPL. There just are entry rules regarding it, whether that trade off the bull bear KPL happens early on in the session or later on in the session. So but Some people prefer to take trades off of the other main and R&S levels, and there is a feature of this indicator which can help you gauge what levels may be best for defined as risk reward as far as stop loss to target exits, and that is going to be the historical bull bear key price level feature and the historical R and S levels feature. There is a video in the description of this video. There's a link to a video on how to utilize that particular feature to go back to previous sessions and study them to look at where the other prevailing where are the typical prevailing bullish and bearish opportunities off of the other main R and S levels as the session progresses. So if you're of more of the mindset that you prefer to take bullish opportunities or bearish opportunities later on the session off of other levels, that particular feature of this indicator is very useful for determining which levels may provide consistently the best opportunities for that by looking at historical sessions, say over the last week, the last 2 weeks, the last month, or even just the last few days, and going back and doing some research on that. So I would invite you to watch that video as well, as that feature can be very useful for that aspect of trading with this indicator. Okay, so we have the 9:30 a.m. opening candle. We have a bearish entry signal. This is the price level that we'd be trading against, the bull bear KPL. Now, how do we decide what put option we're going to use to trade this bearish entry signal? So on any particular level, any main level that you're trading, whether it's a bullish entry signal or a bearish entry signal, excuse me, there's always going to be 3 different strikes that you can consider. One is going to be your standard play, and then there's always going to be 2 out of the money plays. The standard play is going to be the at the money option that is closest to the price of the level that you're taking the bullish or bearish trade from. And then there's always going to be 2 out of the money strikes to consider as well, if you prefer out of the money strikes. And we're going to show you that process now of how to determine that. We also have a video that goes into more detail on this, but we'll just briefly go over it now. If you want to watch that video, that link is also in the description of this video. All right, so we have the level that we're trading, the bull bear KPL, 68.7694. The standard play is an at the money strike closest to the level that you're trading. So the closest at the money strike is going to be the 68.75 strike, and since this is a bearish play, that's going to be the 68.75 put. And what you're doing here is you're going to wait for the close of the candle, and not buy it intra-candle. You're going to wait till right before the candle closes. If it's obvious, as it was in this case, that before the candle close it's down here, you could just buy it before the candle close if you want, say 5-10 seconds before it closes, if you see this. If it's a lot closer to here, then you definitely want to wait for the candle close. But if it's far enough away where it's still going to be a viable 9:30 a.m. opening candle trade, where it's far enough away but where it still qualifies for that, where it's not falling into the exception rule per the video we talked about earlier where you want to avoid it. The main point I'm trying to make here is that if it is far enough away and there's 5-10 seconds before the 2-minute candle closes, you could just go ahead and buy. but if not, just go ahead and wait for the candle to close. The main reason for you're waiting for the candle to close is to make sure which direction on this 9:30 a.m. candle that it is actually closing, because if it started going below it but then rose back above it and closed above it, then instead we'd be looking at a bullish trade. So on the candle close, the 68.75 put is $21.32. That is going to be the price of that option. If you're not familiar with how options work, what you'd be paying for that option is you take the price that you're paying and you multiply that times 100, and that is the price for one option. So the price of one at the money 68.75 put based on 21.32 is going to be $2,132. So let's say instead you were 5-10 seconds before the close, because you felt that it was far enough away where the remote possibility that it would go back up, and you wanted to jump in early instead of waiting for the close. Let's say it was $20, then your price would be $2,000. You multiply the 20 times 100. So let's say it was 20, that would be 2,000. If you bought 2 of them, then it's going to cost you 4,000 for 2 of them. If you bought 5 of them, it's going to be $10,000. Now, what about the out of the money ones? How do we determine that? The price, we look at the level that we're trading, bull bear KPL, the direction that we're trading, bearish, so we look down, and how you determine which 2 out of the money strikes you can consider on this trade from this level is you're looking down from the level you're trading, because it's a bearish play. The first out of the money strike is going to be the closest to the midpoint level below the level you're trading on a bearish play. 68.40 is the price of this level. The closest strike to that is going to be the 68.70 put. So the 68.70 put on the close was $18.67. What's the furthest out of the money one we could consider? That would be the level that we're trading, and we look one full level down. That is the maximum amount you should look down. So the first out of the money is a half level down because it's a bearish trade. The furthest out of the money that you could consider is one full level down from the level you're trading. If instead we were looking at a bullish play, then we'd be instead be looking one half level up and one full level up. If instead this was a trade off of the S1 level, then this was a bearish trade off of the S1 level instead of this level, and we were looking at a bearish trade later on in the session, then the 68.60 put would be the at the money standard play, and then the 68.50 would be the first out of the money, because that would be closest to the first mid-level down here, and then the furthest out of the money one we would consider would actually be the 68.45, because that is the closest to 68.42.79, because that's slightly over 68.42.50. All SPX strikes are in 5-point increments, so 2.5 points is the midpoint between those increments. So that's how you would go about determining. If this happened to be exactly 68.42.50, then you could use either one because it's exactly in the middle. But if it is over the middle point, then you would want to use the one that is closest to that. If this was 68.42.39, then it would be the 68.40, just as an example. Okay, so on this particular, this is the level we're trading. This was the first one. We're trading in a bearish direction, so this is the maximum out of the money here. One full level down, 68.60, and that put option was on the close of this candle, $14.43. Now, what about your stop loss? When using this indicator, your stop loss on your entry, bullish or bearish entries, is going to be level based for your initial stop loss. when the trade starts moving in your favor and reaches the point, which we'll show here in a minute, where you can make an adjustment if you don't close out all of your trades, then you're switching to a price-based adjustment to your stop loss, not a level base. So to begin with, your stop loss on your initial trade entry is going to be level based. And how you figure that out of what are the levels I'm using is what is the level you're trading, in this case the bull bear KPL. Is it a bullish or bearish trade? In this case a bearish trade. So in a bearish trade, your stop loss levels will be above the level you're trading. Your tight stop loss level is going to be the QL above level, and your standard stop loss is going to be the midpoint above the level. So in this case, the midpoint above the level is this, the mid BBKPL R1, which is 68.8540, and the tight stop loss is the QL level above, which in this case is 68.8121. Now, as you can see in today's session, neither one of these stop loss levels was breached. However, there are a lot of times where the tight stop loss will be breached while the standard one is not. So in our opinion, it's always best to use the standard stop loss. However, there are people that prefer to take the chance on the tight stop loss, and if you do that, they would rather take the chance on it getting hit and then make an assessment of whether price action is dictating a re-entry or not on that level or another level afterwards. So you will have technically less at risk with the tight stop loss than the standard stop loss. However, there is more of a chance of it getting hit. So just as long as you're aware of that. Now, there is a link to a video in the description of a video that was made by someone else on YouTube that does a very good job of explaining this particular thing, and that is how to set your stop losses on Thinkorswim using the price of the underlying. So that allows you, that feature in Thinkorswim allows you to set your stop loss based on the price of the underlying, so the price that SPX is trading at. So that allows you, that feature which Thinkorswim has is an additional feature which allows you to set your stop loss by a specific SPX price, as opposed to having to manually just stop yourself out by watching the chart to see if it does hit that price. Now, another broker that offers that feature is Interactive Brokers. We don't have a link to an Interactive Brokers video. However, if you do Google Interactive Brokers, set options stop loss based on price of underlying, you will see some Reddit discussions on that matter, which will have some links that would be where it explains how that works on their particular feature in Interactive Brokers. You can also ask Interactive Brokers directly, their support staff, how that particular feature works. And that particular feature also works on both Thinkorswim or Interactive Brokers for take profit entries as well. So you can also utilize, if you don't want to take your take profit on the close of a candle and you want to consider doing your take profits on exits on SPX hitting a level price or touching or hitting that price, as opposed to a close once it does touch or hit that price, then you can also use that feature for take profits as well. So I invite you to watch that video on Thinkorswim, or if you're with Interactive Brokers, to inquire with them about that. Other brokers, there probably are other brokers that offer that. However, most brokers do not. So just keep that in mind, that if you trade with a broker that does not offer that feature, then you're going to have to manually stop yourself out if it hits your initial stop loss by simply watching price, and then if it does hit that level, you could either set an alert on TradingView for to alert you if it does hit that level, and then stop yourself out. However, you would need to do that manually if you're trading with a broker that does not offer that specific feature like Thinkorswim and Interactive Brokers does. So check with your broker to see if your specific broker does offer that feature, at least for stop losses based on the price of the underlying on options. And if not, then you may want to consider at least trying out a demo account with Thinkorswim to see how that feature works, and then try that out on a demo account to see if that is something that makes more sense for you than just doing it manually. As I said, once you start getting to a point where the trade has moved in your favor of enough of a move, and then you are doing adjustments to your stop loss, at that point you're changing to just the standard price of the option stop loss, which all brokers have. Okay, so there are two different types of trades with this particular indicator. One is using this particular strategy. One is a scalp only trade, and the other is doing regular trades. So on scalp only trades, you are looking for a one level move in your favor, and then you are exiting however many option contracts you have, whether it's just 1, 2, 3, 10, 20, or however many that you have. There's no stop loss adjustment, there's no scaling out, it's just simply on scalps you are exiting your trade. So that is a one level move in your favor, and how you figure a one level move is what is the level that you're trading, what is the type of trade, in this case bearish. So then we're looking down on a bearish trade from the level we're trading, and what is one full level down? That is S1. So here at 9:40 a.m. it hits the S1 level, and all of ours are typically getting out on the close of the candle. So in this case, on the close of this candle, so remember, you could, if you trade with a broker, you could have gotten out on a touch of this if you set it up that way with that feature. However, another simpler way of doing it is just seeing that it does touch it and then getting out in the close, because oftentimes it will close through to a better price on that, and that's not guaranteed that it's going to happen, but oftentimes it does. So that is another effective way of doing it, just waiting for the close of the candle. However, if you prefer, then you can just simply close out on the touch of the level. So at 9:40 a.m. we have the touch on the candle close here, so it's 100% exit of all contracts if you're just scalping only. And on the 68.75 put, it's now 27.30, so that's $598 profit per option. The 68.70 put is 24.30, so that's $563 profit per option. The 68.60 furthest out of the money put is 19.40, so that is $497 profit per option. So at this point, if you're just scalping only, then you're out and now you're flat, and now you can consider other trade opportunities that you may want to consider, or you can simply just hang it up for the day, have your profit, and go do something else. So on regular trades, then regular trades differ from scalps in that you're looking for a minimum required 1.5 level move in your favor for a regular trade, either to close out all of your contracts or adjust the stop loss on all of your contracts, or if you're trading multiple contracts, then you would have the option of selling 70 to 90% of them and closing them out, and then doing a stop loss adjustment on the remaining runners. How do you figure the 1.5 level minimum required move? It's basically the same process. What is the level that we're trading from? What is the type of trade? Bearish, so that means we're looking down. So this is a half level, this is one level, this is 1.5 levels. So this is your 1.5 level trigger here. So at 9:44 a.m. it hits this mid S1, S2 level for a regular trade, minimum 1.5 level move for regular trade. So here we have the decision to make either 100% closeout or adjusting the stop loss on all of them to break even, or break even plus a 10 to 15% profit buffer. So as I was mentioning earlier, here you are changing from a level-based stop loss to a price-based stop loss. And on a price-based stop loss, to break even, you go back to the price that you paid. So that would be break even, and then you're now adjusting your stop loss to price-based, which would now be to break even. Or you're adding a 10 to 15% profit buffer on top of break even. So for example, on 21.32, roughly 10% of that is $2.10. So then you would just add $2.10 to this, and that would make it 23.42. Or you could just round it up to 23.50 for simplicity's sake. And you would do the same thing with the other ones if you were inclined to move it instead of just to break even, add that profit buffer. So the initial profit buffer is 10 to 15%. If you're going to add a profit buffer, alright, so here on this candle here, 9:44 a.m., the 68.75 put on the candle close is $30.80. So that is $948 profit per option. The 68.70 put is $27.54. That's $887 profit per option. The 68.60 put is $22.10. So that's $767 profit per option. All right, so as you can see here, it did go down a little bit more. However, it did not quite reach the S2 level, and then it went back up to break above this S1 and then test the mid BBKPLS1 level here before resuming the downturn here and closing back below S1 and the PML level here, and then staying under the PML and S1 and headed back towards the midpoint, closing below that midpoint, and then now we have the 12 p.m. candle where it hits S2. So this is what is a two-level move. Again, what is the level we're trading? What is the direction? Bearish, looking down. Half level, 1.5 level, 2 levels. 2-level hit, that is considered the ideal two-level move. So whereas the 1.5 level move is the minimum required, the ideal minimum move on a regular trade is going to be 2.00, a two-level move. All right, so here the 68.75 put on this close 37.39. That's $1,607 profit per option. 68.70 put 33.39. That's $1,472 profit per option. And the furthest out of the money 68.60 put 25.80. That's $1,137 profit per option. Now I have a note here. If already adjusted SL previously, add additional profit buffer amount if not closing out. What that means is that if you already did a SL adjustment here of 10, whether it was break even or break even plus 10 to 15%, then if you did add a 10 to 15% profit buffer here, then here you would want to add more of a profit buffer because now it has hit another increment below. So here you would add on more of a profit buffer down here of whatever you feel comfortable with, whether you just want to add another 10 to 15% or add more. You just have to be cognizant of the fact that if you add too much, then you run the risk of just being stopped out on a retrace. So it's just a choice between just more of a liberal amount or a tight amount. Really, that just takes time and it takes practice to see what works best for you. Obviously, another thing that you can do is just simply close out all of your contracts, whether you had runners or you had not closed out any of them and you just adjusted the stop loss here, and now it's reached this, so you could simply just close them all out if you don't want to do any more adjustments or think about it any longer. Alright, so here at 12:58 p.m. then we finally get a hit of another level down, the mid S2, S3 level. Now we have a 2.5 level move on a regular trade. So again, the level that we're trading from, this is the trade level we're trading from. Bearish trade, looking down, half level, 1.5 levels, 2 levels, 2.5 levels, mid S2, S3 on this 12:58 candle. So here you have all the same decisions to make. If you already previously adjusted and added more of a profit buffer here and you were still in this trade, then down here you could add on more of a profit buffer here. One thing to note here is that this level is very close to the yesterday's daily close and yesterday's daily lows. Now you're seeing both the yesterday's daily close and YDL all in the same confluence with each other here. So normally in a lot of sessions you may see a stall out or a reversal off of YDC or YDL and off of one of those levels. Well, here you have both of those levels next to each other. So in this case, if this started closing a lot of candles below here and just staying below it, then we're probably going to see a much further flush because these are two important levels which oftentimes you'll see a sideways move or maybe a little test below like we did today, and then you'll start seeing a reversal off of these because basically the market makers have just wanted to go down here, test out these levels, and now they're wanting to move price back up from these levels. That's not always guaranteed. It's just that a lot of times you'll see reactions off of this level, and sometimes if they're hell-bent on really taking the market down, then you'll see some action like this go back up, and then you'll see a huge candle down off of that. So the main point I'm trying to make here is that you have to be cognizant of the fact that this can be the end of the road here. We've gotten all the way down here. We're past the ideal minimum 2-level move. We're down to a 2.5 level move here that is occurring right around where YDC and YDL is. So this would be a good point to either really tighten up your stop loss or to just go ahead and close everything out, because of the fact you're running, the odds are against you here with all of these. That doesn't mean that we could have gone down and sliced through this and been one of these days that would be an abnormal day where this would have continued past these two levels and just kept going many levels down. So that's why it's important to keep in the context of having these levels along with the other ones. So this shows you where these can become of extreme importance when you're starting to manage a trade. Alright, so on this 12:58 hit, S2, S3, 68.75 put, 51.73, that's $3,041 profit per option. The 68.70 put, 46.50, $2,783 profit per option. And the 68.60 put, $37.50, that's $2,307 profit per option. Now, just to show you here what the price was when it does hit both of the YDC and YDL levels here. At 110, it hits YDC and YDL. The 68.75 put was 53.79, $3,247 profit per option. The 68.70 put, 47.40, $2,873 profit per option. The 68.60 put, 39.15, that is $2,472 profit per option. Okay, in today's video we're going to go over another point that we haven't brought up in a while. We've had brought up this point in some of our videos that we've made 4 to 6 weeks ago, and then before that, and that is the lotto plays at the end of the day. So if you've seen some of those other videos that occurred a while ago, we talked about part of the strategy if you have significant profits from earlier in the session. And if you have significant profits early in the session and you want to continue trading throughout the rest of the session, then you have the opportunity to look at considering some lotto option trades. So the lotto window on SPX, because it closes at 4 p.m., starts at 2 p.m. and runs to the 4 p.m. close. So generally you want to enter any lotto plays before the 3:40 p.m. to 3:45 p.m. window hits. Excuse me. So you may consider your entry window as really the 2 p.m. to say 3:45 p.m. And the general lotto play rule is only use up to 10% of your session net profits. That means your current session net profits on any lotto play you are considering entering, as there is a high chance they may go to zero. But they can also return 4x to 10x or more. There's definitely sessions that have occurred where lotto plays have returned 20x, 30x, and sometimes even as much as 80x when we've gotten some monstrous moves at the end of the day. Those may happen once or twice a year. But there are a lot of plays that do return 4x to 10x that do occur quite often. However, just as it states here, these are lotto plays. So remember, the term lotto, it means that there's also a high probability that you will get nothing and that your lotto trade, can end up going to zero. And that is why you have to follow this rule of only use up to a maximum of 10% of your current session net profits on any lotto play, because there also is a high likelihood that it is going to end up going to zero, or that you will at least lose money on it if it does not go to zero. So that is why you do not want to use more than 10% of your current session net profits, because if that does happen, if you lose money on this lotto play or it does go to zero, you still have 90% of your session profits intact. So generally, you're looking for lotto options that are going to be in the range of 30 to 50 cents to approximately $3 or so. And we don't have the specific plays on here. There really just wasn't enough room, so I'm just going to verbally go over them now. However, we are going to look at all the different lotto plays that you could have considered on the Thinkorswim data box option charts. And we will look at the ones that went to zero and didn't work out, which there were 2 of those, and then we'll look at the 2 that did work out. Okay. So what is the strategy behind the lotto option? So basically, you're looking at starting at the 2 p.m. window. Now keep in mind that you can wait until just before 3:40, 3:45 to enter a trade as well. The one we're going to talk about today, or the ones, all of the ones we're going to talk about today, are going to be ones that you would consider starting at the 2 p.m. window. So we're just going to look at what it was looking like from then on, say from the 2 p.m. to 3 p.m. And so what the decision would have been to either go one way or the other, or to try both sides. As we'll see that when you get into this sort of strategy at the end of the day, that it can make sense in some cases to also do both calls and puts in what's known as either a straddle or a strangle. And generally speaking, straddles are typically, unless you have a ton of profits from trading earlier in the session, let's say you were trading multiple contracts and you had say $10,000 or more in profits, then you could consider straddle plays. Straddle plays are still going to be fairly expensive, say in the $6 range, or maybe as much as $12 range once you start getting in the 2 o'clock and on scenarios. So if we're going with our 10% rule, let's say they were only $6, then you would have to have $6,000 in session profits to consider doing that based on the max use up to 10%. Whereas strangles, as we'll see here in a second, out of the money strangles can be a lot cheaper. They're also a little bit more risky than a straddle at that point. However, they are going to cost less, so that's kind of the offset with those. So, but we're going to look at both a put lotto option play and a call lotto option plays. Okay, so we have basically this sideways movement here off the S2 level. So starting at 2 p.m., we're trailing around and just chopping around this S2 level. So basically there were two ways that you can look at this lotto trade. So either we're going to flush back down or we're going to go back up. Usually on days like today where you've gotten this move down and now we're kind of like curling back up, usually it's not going to, as you can see, we kind of ended up the day basically where this is here. However, before that happens, you're generally not going to see on days like this for this just after 2 p.m. to be a straight line left to right, where it's hardly anything's happening the entire rest of the day. You're going to get some kind of additional move before the end of the day. They may end up exactly here again as they did here after that, but generally you're going to see something. You're going to see either a move in both directions to try a multiple shakeout, or you're going to see at least one move. But we don't know whether that move is going to be to the upside or downside. So hence the lotto play is there's only a couple different ways you can do the lotto play. You can either take both sides, you can take a strangle, or if you have enough profits, as I said, you could do a straddle if you had enough profits to meet that 10% threshold. A straddle, for those of you who are not familiar with it, is buying a put and a call at the same strike price. Typically, you're going to buy that at where price action is. So let's say we had 68.42 here. That would be the 68.40 straddle. So you'd be buying a put and a call. And then you'd be paying, double. You're paying for a put and a call. And then the enemy at that time is no price movement. So if on a straddle you can profit from it going in either direction and you don't have to pick a direction. However, the enemy of the straddle is low volatility. So if it doesn't go anywhere, then you're losing money on both sides of the trade with the time value decaying on both options. So the straddles, even though you don't have to pick a direction, and you can get a pretty decent profit from even a moderate move at this point in the session, the downside of the straddle is going to be if it doesn't move, you can start having that rapid deterioration. So that's why, again, if you do have enough money for a straddle within that 10% rule, a straddle can be a very good choice because of the fact that you're not having to pick a direction. And you're, like I said, your only real enemy at that time is going to be the volatility. So if the volatility never comes and there's not another move, then it will just be a burn on both sides of the time decay. Excuse me. So you're going to, but again, you have to remember that with the lotto play, the best way to look at the lotto play is that it's going to go to zero. So that's why if you're going to enter into it, obviously we don't want it to go to zero. We don't want to lose any money on it. However, that's why you're only taking 10% of your session profits. So if you made $6,000 and you want to take 600 of it and do a straddle, when the straddle happens to be $6, then you're potentially looking at, okay, I'm willing to risk 600 because maybe I'll make $2,000 or $2,400 or $3,000 on this. So I'm willing to take 10% of my profits to do that. So it's really just best to look at it like it's going to go to zero. That's why I'm willing to only risk 10%, because there's a very good chance I will end up losing all of it. Okay, so that's one thing you can do. The second thing you can do is if you just want to look at a bullish lotto play option, then you would look either to this level above or this level above, because we're trading at this level here. So you would look to either this level here. So just to explain, lotto plays are a little bit different than the plays during the main part of the session. So the plays during the main part of the session, you're taking those trades off of the bull bear key price level or the main R or S levels only, not midpoint levels and not the QL levels. However, when you get to the lotto part of the session, if you're going to ever consider doing lotto trades, you're looking more at where price actually is at that time, because remember, lotto plays, you're generally going, although you can use a stop loss, it's really best with lotto plays to look at the stop loss is just actually the zero, because you need to go into it with it's better to go into lotto plays with the mentality of whatever money you're putting up, and that's why you shouldn't put up any more than 10% of the previous session profits, because as I said, it's best to look at lotto plays as if they will go to zero. So zero is basically your risk. That's your risk. You can use a stop loss if you want. However, you'll probably find more success without using a stop loss if you'll just look at it in that perspective, that whatever money I'm paying for this option, that's my total risk. Because a lot of times you may have to wait until later on in the session to have it play out where there's some sort of substantial move. So it's best to go in with that mentality. So with that in mind, you're just looking at where is price of that option going to fall within this, if I'm just buying a single option and not a straddle, where the price is either going to be somewhere between 30 to 50 cents to approximately $3 for one option. So while price is here, if you want to look at a bullish option, you would look up, and what's the closest strike to this S1, S2? That would be 68.50. Then you would also look up here to this level, 68.59.86. That would be the 68.60. Well, in this case, it just happens to be the 68.60 call that falls into that scenario. And then another one, because this one down here is still too expensive at this time. And then the other one is going to be this midpoint level, mid BBKPLS1, which you can see we were at earlier in the session, rose back up to that 68.64.40, so that's going to be the 68.70 call option. So both of those, 68.60 and 68.70, fall into this pricing scenario. Now, what about on the downside? If you were inclined to look at this as a possible put option play, then you would look to the ones on the downside. So you have this midpoint here, 68.25.72. So that would be the 68.25 put. and then you have the 6808, so that would be the 6810 put. And both of those happen to fall into that pricing range. So those are going to be the four we're going to look at. Now, you could also use a strangle, which you could take a combination of one of those two calls and one of those two puts and buy one of each, and that would be known as an out-of-the-money strangle. And then you could profit from a move in either direction. However, when you use a strangle, it's going to have to be a lot bigger move, because it's going to have to overcome the price of both of those options for one thing as a combination total. So you're going to have to get more of a move in order for a strangle to be profitable. Okay, so with that, if you were inclined to do a bullish opportunity, then you would look at where are some points here where, starting with the lotto window, that it looks like a bullish opportunity might be taking place. So we may be moving back up, and it's holding here above this S2 level. Now, so one entry would be, say, right here, after it's got some sideways movement after popping up. So here about the 2:28 p.m. And as you can see here, it did have a move back down. But again, remember on lotto plays, even though you could use a stop loss, it's typically better to view it as just the cost of the option. It's just basically your total risk. Because again, we're not taking more than up to 10% of our profits for any one of these. That's up to 10%. Where's another area? So if you missed that one there, where would be another one? Let's say you missed that. You were focused on what's a bullish opportunity, and let's say you, for whatever reason, you didn't take that one. The next one would be here, where you see it finally, after this looks down, it goes up, pops above here slightly, and then has this candle here. So this is the 2:58 p.m. candle. So the 2:28 p.m. candle, then the 2:58. Now, what about on the downside? On the downside, you really see here, you have this candle here popping down, and then you have one here and then here. So here, this candle here would be one of the candles you would consider if you were looking for the put play of either getting this option here off this level or this level. So that would be the entry that we'll be looking at on the lotto option there. And again, if you did not want to be concerned with looking for this, then you could simply, because it's at this level here, then you could pick a strangle that would be a combination of one of the options up here and down here, and then you're just waiting for it to make a monster move. Or you go with the straddle while it's trading down here. The straddle of the at the money straddle closest to this would be the 68.45 or the 68.40s, and then as long as it falls within this max 10% rule of the cost of the straddle. So the cost of the straddle may be too much here. Let's say you had $6,000 in profits and the cost of the straddle here is 10. Well, if you're waiting for a straddle later on, because you're more inclined to look at a straddle, and let's say you did have $6,000 in profits, so you did have a $600 limit of how much you could pay for it, then you would look for a straddle. When does a straddle become $6 or less? Maybe it becomes $6 or less here, or maybe it becomes $6 or less here when you get to the 330 level. Or remember, you want to enter any lotto plays before 3:40 to 3:45 p.m. So maybe the straddle price is within the range of where you can afford to buy it using your max up to 10% of session net profits rule. Maybe your straddle play, if you're more inclined to use a straddle other than picking a side or doing an out of the money strangle, then you're waiting to see, does the straddle where price is at. So if it's back here at, say, the PML level, 68.61, that would be the 68.60 straddle. If it's in this range here. If it's up here, then it'd be more looking at the 68.70 straddle. but you're looking more where does the straddle fall into my max 10% of session net profits rule for the cost of the straddle. If you're more inclined to do that, as opposed to picking a singular option of either a put or a call, or doing the way out of the money strangle of a combination of an out of the money put and out of the money call. Okay, so what we're going to do right now is we're going to first look at the lotto options charts first, since we're just ending on this topic, and then we will take a look at the thinkorswim option charts on the main play today. Okay, so first we're going to look at one of the put options. This was the furthest out of the money put option that we could have considered for a lotto put option play, just picking a direction. As you can see here, this was the candle I pointed out where it popped down, and on this candle here at the 2:50 p.m. it's $1.20. As you can see here, it did basically go to zero at the end of the day. So again, as I talked about, the lotto plays, a very good chance it's going to go to zero. In this case, if you just picked a directional play of a put lotto option and you picked this furthest out of the money one that you could consider, again, it's basically based on price, $1.20, so that means you would have paid $120 for this option, and then you would have lost all of your money. Next, we'll look at the other lotto put option. Okay, so here we have the other lotto put option, the 68.25. Same candle, 2:50 p.m. Close of this, $2.82. So that entry would have cost you $282. And as you can see here, you would have lost all of your money on that particular option. Next, we'll take a look at the two call options. All right, so here is the 68.70 lotto call option. This is picking a direction. So here was the initial 2:28 p.m. and then here's the 2:58 p.m. So this is if you did the initial one. Cost is $1.30, so that's $130. If you waited till you had that big pop-up candle, which happened later, then you basically the cost is the same. Why is it the same? Because now, even though that candle was higher than this one, it did occur later in the session, so you had more of an erosion of value, and that ends up being about the same. So that's $1.25 here, so that's $125. Now this particular one in this direction, as we saw, did move out, at least initially. As you can see here, if you held on to it for the end of the session, then you would have ended up losing all of your money. So that's why it's important with lotto options that you set a price for the exit of what multiple you want to have, or you're going to have to be pretty quick on the draw if you want to exit these, or you're going to have to use an exit on a price level hit by using a broker that has one of those features. So if you don't want to go through all that, and because during the end of the day, a lot of times the better prices on getting out of your lotto options are just going to be just basically setting a reasonable multiple that you consider that you're going to be happy with. However, if you want to stay in to see just how much you could squeeze out of it, then you're either going to need to stagger your exits if you have multiple, if you had enough of a profit to afford multiple lotto options, if you had enough of a profit to where just 10% of your session profits allowed you to buy multiple lotto options, and you could set staggered exits, some at one price, some at a higher price exit, or just pick a level, a price level, and just do a closeout when it hits that particular level if you are using a broker that offers that, where it's based on the price of the underlying. As we went over earlier, there's only a few brokers that offer that, like thinkorswim, Interactive Brokers, and possibly a few more. Okay, so here we have where 3:26 p.m. 3:26 p.m. it hit the S1 level, so it went up. Remember, these were starting out on the S2 level. Well, this is when it hits here at 3:26 p.m. where it hits the S1 level. So now we've gone up one level, and at 3:26 p.m. and the high of this candle 310, and the close was 3. So you've gone from either $1.30 or $1.25 all the way up to 3. Now at 3:28 p.m. it actually hits the pre-market low level. The high of this was $4.05, and the close of this candle $3.40. Now here at 3:34 p.m. is where it hits mid BBKPL S1, and the high for this, remember this is the furthest out of the money call, the 68.70. So this was the furthest out of the money one. That's why the price was lower. And the high of this on this big wick up here where it touched the mid BBKPLS1, you had $6.20. So you would have gone from $1.30 or $1.25 all the way up to $6. The close of this candle, $4.10. So you can see you have to be quick on the draw with these late day plays. Next, we'll look at the 68.60. Okay, so the 68.60, remember that was the closest one that we could consider that was to the S2 level, and that's price here at $2.28, $2.90. Price here at $2.58 entry. If you did that one instead, $2.95. Here is the 326 S1 hit, high $7.20, close $7.15. Here's the pre-market low level hit at 328, high $9.60. So we've gone from 290 or 295 to 960, and the close of this candle $8.10. Here where it hits mid S1 S2, we got a high of $12.50. So going from 290 or 295 to 12.50 potentially, and then the close of this candle $9.40. Okay, so if you want to look at how it would have worked out had you picked one and you did a strangle, you can simply look at freeze frame, go back and freeze frame these prices for one of these call options and the prices for one of the put options, and then you have your out of the money strangle. Would have just been a combination of those two, and you can see how that would have worked out. Obviously the puts went to 0 while the calls went to these prices here. However, so you did have the cost of both of those on an out of the money strangle, and then you're just waiting to look for the combined price of both of them to reach a certain multiple for you to do your exit. And as we saw here, we got enough of a move where in this case of today, an out of the money strangle would have worked out in your favor, so you would not have to have picked a direction. Now the only one we're not going to take a look at in today's session, which we will in a future session, is the at the money strangle, which that was just basically based on where does price come into the cost of that, and many people may not have enough of a profit in order to justify using up to 10% or be able to use 10%, because the price of the straddle is usually going to be somewhere between the 2 p.m. to 3:45 p.m. range. Would be probably anywhere from $5 or $6 on the low end, getting closer to the 330, 335, 340, 345, to earlier in the 2 p.m. Window, probably more in the $10 to $12 range. So that would mean you would have to have significant profits in order to have 10% available. But if you do want to look at those, we'll just go back to the chart real quick. Then just go back, look at the, you can go back and look at the prices of what a straddle would have been at these different times to see if you think that you would have ended up with your type of trading account you have, you would have had sufficient profits to look at a straddle as a valid potential lotto option play, and then how those would have worked out. Okay, so thank you for taking the time to watch this video today. If you did like the video, please like the videos. That helps us out with our YouTube algorithm. And if you'd like to see more videos, you can subscribe to our YouTube channel, and you'll be notified when we upload new videos as soon as that happens. And as mentioned at the beginning of this video, if you are interested in purchasing this indicator, we sell all of our indicators on a one payment for lifetime access basis, which means you pay once and then you have lifetime access to the indicator, which also includes any updates or any other versions that come out in the future that will have enhanced features or additional features. So if you can also, and for a return of taking your valuable time to watch this video today, as we mentioned early on in the preview to this video, you can email us at daytradinggps@gmail.com and request a discount promo code to purchase this indicator. And then we will, in return for you taking the time to watch this video today, we will send you a promo code for a substantial discount off of the regular price. So email us at daytradinggps@gmail.com to request that promo code. Thank you again for watching this video, and we wish all of you prosperity in your future trading endeavors.